for Ask Annex. As always, got a question for us, you head to our website, annexwealth.com, look for the Ask tab, and as always, if we can help you, just click the Get Started button. Sarah Kyle's in the studio, Wealth Manager at Annex Wealth Management. Hello.
Hello, Danny.
Matt Morzy is Investment Team Manager. Welcome.
Hey, Danny.
Our first one is from Ken. Thanks for the show. I always enjoy listening. You speak often of Roth IRAs and Roth conversions. When is a Roth IRA not a good idea?
Deciding when to open one and when to do Roth conversions takes some planning. The Roth IRAs are primarily designed to be long-term retirement savings vehicles, so I wouldn't suggest opening one with money that you need within 5 years because that growth will be taxed. You can take out contributions to a Roth IRA tax-free anytime, but that Roth needs to be open 5 years before growth comes out tax-free as well.
Next up is from Ted. Should I be invested in all 11 sectors?
Yeah, it's a great question and something that we talk about a lot internally within the investment committee. When we look at the different sectors that are out there, you really do want exposure to all of them because not only do you want the exposure, because you don't know what's going to do well necessarily over different time frames. Take energy for an example. Energy fell down to as low as about 2% of the S&P a couple of years ago, but it's now been the best performing sector over the last 2 years, and it's back to almost 5%. So those weightings ebb and flow over time, so you really don't want to stay away from them. But also just the effect of staying away from a sector or two might mean that you're way over concentrated in another area of the market too that you don't want to. It's another risk to look at.
Is there always a dog somewhere in the 11?
There's always something. There's always something that's outperforming and something that's under, but you certainly want to watch out to make sure that you're not on the wrong ones there.
It's Ask Annex. Next up, Anonymous. What's a mutual fund tax bomb? How do I avoid it?
Yeah, mutual fund tax bomb is essentially the idea that those funds are pooled investments from a lot of different investors. And somebody eventually has to get taxed on the capital gains that happen within those mutual funds. The fund itself doesn't. So what they do is at the end of the year, they see everyone that owns it and they distribute that capital gain out if there is any. So if you're holding that mutual fund in a taxable account, you're going to all of a sudden get a distribution near the end of the year and it's your share of those gains. But it's taxable to you. Now, a lot of times you're reinvesting those capital gain distributions back into it. So you're really not even seeing that money, but you still owe the taxes on it. So that's what they really refer to as a tax bomb. So the way to avoid it, in my opinion, is to make sure that you know what you own and where you own it. So whether it's a traditional IRA or a Roth IRA, a lot of times you want to have actively managed funds in those types of accounts and maybe hold an ETF in the taxable account so you don't have that capital gain distribution.
Yeah, so we saw in 2021, right? Lots of big distributions, capital gains distributions. Not so much last year. You can also avoid those fees by not purchasing the funds right before the distribution date. And then you can also consider tax-efficient funds.
Yeah, exactly. ETFs, tax-managed mutual funds, making sure you know when you're buying into a mutual fund are all great ideas to avoid that.
Next question on Ask Annex is Anonymous. Is paying extra on my mortgage a way of investing? I say it is. My coworkers disagree.
Well, paying off your mortgage early can be seen as a form of investing, but I would say it's more along the lines of financial planning. You made the investment when you purchased the house. How and when you pay it off is more along the lines of financial planning.
Next up on Ask Annex, it's Anonymous. Last week you said passive funds might be only rebalanced once a year. Did I hear that correctly?
Yeah, certainly. And it really depends on what type of passive vehicle that you have. Now, keep in mind that key word there is passive. So it's not an active manager trying to beat an index. They're just trying to match the index. So they're really only going to make changes when the index does. And a lot of them only do make changes to that index by adding new stocks or taking away stocks or bonds once a year. And in that case, that ETF is going to duplicate that. They're going to go ahead and make that change. Now, some funds are like equal weighted funds, and they might do it quarterly, because they need to trim off the gains and then buy some of the ones that have lost during that time period to keep that equal weight in mind. But if you have a market cap index and you have a stock that keeps going up, it's never going to sell because it's trying to match what that index is.
Hey, I got a question. I'm seeing a ton and hearing a ton of ads for precious metals, and you can buy the coins, you can buy the ingots or whatever they are, you can buy shares. What's the way you usually see it done?
Well, we usually recommend actually buying the miners, not the physical gold. Because you think about it, what if you bought a ton of gold bars? Where do you store them? Or if you pay somebody to store them for you, there's high fees involved. So you typically see a lot of commercials when there's volatility in the market. You see all the silver commercials, the gold commercials. They aren't giving you those coins and those bars or whatever for free. There's always a fee associated with them. So just be wary of that. And I would just say the most convenient way would be to play it via the miners. How do you feel, Matt?
I'm certainly not a proponent of trying to buy that, especially off the commercials, because they certainly are going to have high fees and markups as a part of that process. And like you said, not only do you have to store it, but now you want to get cash for it. So now you got to find some place to go deliver it and sell it back too, which is going to cost costs you an additional set of fees that's really high. So finding an ETF or a mutual fund that either tries to track the performance of a specific metal that you're looking for, or you said like companies like gold miners or silver miners that are actually involved in the production of it is another way to gain exposure. But I'm always thinking is myself, if I want to get out of this, how am I going to do that and what's it going to cost me? So whatever the easiest way to do that is the route I'm going to go.
Yeah, and I could never just see taking those silver coins to the grocery store and paying for something with them.
I just want it like in the movies where you open a vault and that light shines in and it just glints.
Scrooge McDuck, he's diving and swimming through the coins, right?
Exactly. Matt Morzy, Investment Team Manager, thank you.
Thank you.
Sarah Kyle, Wealth Manager, Annex Wealth Management, thank you.
You're welcome, Danny.